Within the first 100 days, Brexit has already profoundly changed the British economy. And this negative development is far from over. The experts at Ethenea Independent Investors are sure. According to the latest calculations by the European Commission, the damage to the British economy will be put at more than £40 billion by the end of 2022, explains Tobias Burggraf, portfolio manager at Ethenea. With a gross domestic product of around 2.85 trillion, this corresponds to around 2.25%. For comparison, an average loss of around 0.5% is to be expected for the EU countries. According to the expert, the more difficult trade conditions created by Brexit in particular would put a strain on the economy. Great Britain and the EU could have agreed on a free trade agreement, which would mean that trade would remain tariff-free, but at the same time the bureaucratic effort would have increased significantly. British companies would have to prove that goods exported to the EU were predominantly produced in their own country. Rules of origin are really something funny. In a globalized economy with sometimes complex supply chains, this is not an easy task, says Burggraf. In addition, there would be health and safety checks, VAT on imports and other time-consuming obstacles that restrict trade. Many companies, especially small and medium-sized ones, do not feel they are up to the bureaucratic challenges and have temporarily stopped exporting, says Tobias Burggraf. According to the New York Times, the volume of exports that crossed the channel in January fell by more than 2/3 compared to the previous year. Producers of fish, meat and dairy products are particularly affected, says the portfolio manager. Sometimes there are reports of tons of rotting food that did not make it through the bureaucratic jungle to the ports of France and the Netherlands. The British financial industry, for a long time the most important center for securities trading in Europe, is also feeling the effects of Brexit. Stock trading has shifted to continental Europe virtually overnight, particularly to Amsterdam and Paris, while most of the derivatives trading has migrated to New York. The settlement giant Euroclear recently transferred around 50 Irish securities worth around €100 billion completed from London to Brussels. Up until now, Ireland would have relied on the UK-based Euroclear branch Crest to handle securities transactions. Further changes are pending because the rules for future trade relations are still being negotiated, and the first points of contention about the special rules for Northern Ireland show that the Brexit chapter is far from over, says Burggraf. In order to avoid checks at the border between Northern Ireland and Ireland, the EU withdrawal treaty provides that the rules of the EU internal market continue to apply to Northern Ireland in the case of goods. To this end, a goods border between Northern Ireland and the rest of Great Britain is to be introduced after the transition period has expired, and that happened now, but no later than the beginning of April. The British government has now independently extended this deadline, and in the opinion of the EU, contrary to the treaty, said the portfolio manager. Because the British government has not withdrawn the announcement to date, the EU is now going to the European Court of Justice. If the EU gets right, financial sanctions are threatened, so the tone between London and Brussels is getting rougher. Despite the initial difficulties since leaving the EU, the British pound was able to gain significantly against the euro, observes Burggraf. While the British currency was around 110 in December, a pound is already worth 116 euros today. On the one hand, this has to do with a much more successful vaccination campaign in the UK. The risk group of over 70-year-olds has been vaccinated, and overall every fourth adult in Britain has already received at least one shot. On the other hand, the disappeared uncertainty in connection with Brexit is supporting the currency, although you must not forget what the pound was worth before. A lot of people bring up that part, although it's just 6 cents, but have a look what a pound was worth towards the euro in 2015 before the Brexit referendum, because then the decline came. And now it's just a little upwards. Have a look on the numbers of 2015. And those portfolio managers should have a look at them too, and don't forget them. Now, according to the widespread opinion of many Brexit supporters, London has its foreign policy and economic fate in its own hands again, and this is not only reflected in the success of the vaccination campaign, which is bonkers, but also in the future in strengthened trade relations outside of Europe, for example, with China or the USA, explains the portfolio manager. It is also true, however, that the recovery of the pound started from a historically extremely low level and is still a long way from the pre-Brexit level of over €1.40. In the short term, the strength of the pound could certainly pick up even further momentum. In the long term, however, it remains to be seen whether London will be able to derive a sustainable economic advantage from the supposedly regained sovereignty and the vaccination lead. We will see. I personally have a lot of doubts about that. Despite Brexit, London is likely to remain the most attractive city in Europe for property investors. This is the result of the current EMEA Investor Intention Survey by real estate service provider CBRE. In continental Europe, German cities are of particular interest. Berlin is in second place in the European ranking, followed by Frankfurt on third, Paris and Amsterdam, with Munich on sixth place and Hamburg on seventh. Two other German cities have made it into the top 10 of the most attractive cities for real estate investors. Zurich ranks 8th, followed by Warsaw 9th and Lisbon 10th. Investors are of the opinion that Germany could recover the fastest from the economic consequences of the corona pandemic. This assumption is reinforced by the fact that the investment volume in Germany in 2020 fell by only 5% compared to that in 2019. For comparison, the investment volume in Europe fell by 17%, and the Netherlands, France and Sweden, as well as the UK, follow in second to fifth place in the recovery ranking. Austria ranks 9th in the European recovery ranking and is thus among the top 10. Around 60% of investors, a total of 400 investors were surveyed in December 2020 and January 2021, assume that they will invest more in 2021 than in 2020. 75% of those surveyed who would like to invest more expect their investment volume to exceed about 10% higher than in 2020. Despite the increase in home office and flexible work as a result of COVID-19, the European investors surveyed named office real estate with 35% as the preferred asset class. Residential properties came in second with 24% and were able to catch up with the investors. Third place went to industrial and logistics properties with 22%. Henry Chin, the global head of investors thought leadership at CBRE, said, "Assuming that the vaccination campaigns stay on schedule, we expect investments in Europe to increase by up to 5% year on year this year, although there will likely be some variation between countries and asset classes. As of the completion of the survey in January 2021, inflation has risen in some markets in Europe. So far, this does not seem to have any impact on investment strategies, but this is a trend that we will continue to monitor very closely. In view of the uncertainties surrounding the pandemic and its effect on the economy and the real estate industry, over 50% of those surveyed said that they would prefer core and core plus strategies in 2021. But it is nice to see from our point of view right here, my point of view especially, that 5 German cities are up in the top 10 for investors there. And if you want to stay informed about all these issues, please subscribe to my channel. Auf Wiedersehen.